Well, good afternoon and welcome to our HighRock weekly client webinar where we will talk about what we see happening in the global economy, in financial markets, and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our and your investment strategies. As you likely know, if you are a regular listener, we invest our money in the same exact models as our clients. We think that this is a very important highlight and defines our prudent and disciplined investing strategy. Our discretionary portfolio management not only ensures our legal fiduciary responsibility to our clients, but also enables us to make quick decisions and execute them immediately for all of us simultaneously. In tricky and volatile markets, this is crucial as we take advantage of the opportunities that avail themselves to us. I'm Scott Tomlinson, and joining us on the call today is my partner and colleague Paul Tepsich, the founder of HighRock, and our certified financial planning professional and wealth forecast specialist, Bianca Tomlinson, has taken a short leave to have her first child, but she'll be on call to us for her expert advice should we need it for our clients. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this, and all you need to do is visit our homepage and click on the Introduction to HighRock Private Client button. While you're at it, you may be interested in our voluntary code of conduct as well, something that we think takes us above and beyond the regulatory requirement in many ways and highlights how we always put our clients' interests before our own. Well, let's start with a quick review of our themes for 2017. We think that our strategy of taking a tactical approach to investing is even more important this year because of the even greater levels of uncertainty imposed on financial markets by an onslaught of evolving factors. Inflation is a key determinant of central bank policy. While most central banks have been more cautious, the U.S. Federal Reserve has raised rates by 0.25% in March and is expected to do so in June and at least one or possibly two more times after that this year. Stock prices and valuations are at 14-year highs, and excess liquidity has been driving most stock markets. The Trump agenda has run into political hurdles. Brexit has been initiated. The French elections rejected populism, and now we're going to see what comes out of the UK elections, which are happening today. Meanwhile, protectionist agendas continue to raise concerns. Throw in escalating tensions with North Korea, global cyber attacks, Russian hacking, and terrorist threats, and we have quite a blend of political uncertainty. Well, part of our desire to get more tactical is the changing nature of the correlations that used to be the backbone of the old school buy and hold philosophy, both in the U.S. and in Canada. And Paul, we've seen some pretty significant bond moves this week. How is that impacting our correlations?
Yeah, that's we certainly did. We were just talking about this earlier today. And as people can probably see in the bottom part of the chart, the correlation between stocks and bonds, and we're looking at in Government of Canada 10-year bonds and the TSX, which is in white above. You can see over the past week, it's kind of trailed down a little bit, but really what has happened is bond yields around the globe, most certainly in the U.S., have had have rallied substantially, i.e., yields have gone lower and bond prices have gone up. And as you can see in that chart Scott has up right now, the white line stocks have moved higher to all-time record highs yet again. So there is a bit of a divergence happening here. And in the bottom part of the chart, you can see over the past week that blue line shaded green has trailed off just a little bit. And it's surprising that it's not off even more or sloping down to the bottom right more than it actually has. But we will continue to follow this correlation. But at this stage, one would think that if stocks did sell off substantially, that bonds would continue to rally or yields would go lower and prices up and provide more and continue to provide the proper portfolio hedge for us. at this stage.
All right.
That's it.
Thanks, Paul. When we started our private client division over 2 years ago, we wanted to add a third dimension to the standard buy and hold balanced portfolio of equity and fixed income in an effort to add more value to client portfolios by reducing risk and further enhancing risk-adjusted returns. In essence, this, along with our strict adherence to our code of conduct, defines what makes High Rock different and better. So we are patient, waiting for opportunities to buy assets for our portfolios, and it may be a reason why newer clients might still have a bit more cash equivalent assets on hand, because building a solid portfolio takes time. No need to rush in and buy expensive assets if we believe they are going to get cheaper. And each week we look at the benchmark indices performance to allow you to make comparisons to your own portfolio performance. We take the allocation to the benchmark All Country World Equity Index, ETF, and blend it with the Canadian Bond Index, ETF. And from that, we get a weighted return for comparison purposes. You may note that while the one-year blended benchmark net of fees has returned just a little under 10.5%, the two-year annualized return has only returned a little over 4%, about 4.25%. Which highlights the volatility over the last couple of years. Even the return over the last 3 years is well below the 5-year average. Now, our focus is on reducing volatility in our portfolios in the short term in order to avoid big swings in return and capture more consistent long-term returns. And as we look at a longer-term High Rock private client, the one-year total return performance after fees is just a little over 9%. A little behind the benchmark, but with about 25% in a money market fund, this portfolio is significantly less exposed to expensive risk assets like equities, which we believe are vulnerable to at least a 10% correction. But the longer-term 4.5-year performance is still well ahead of the benchmark, a sign that we have been successful in lowering short-term volatility, which does in fact enhance longer-term returns. And I know that we show this each week, but we want to make sure that everybody realizes that at High Rock, we're focusing on the difference between the absolute returns and risk-adjusted returns. The actual High Rock private client return per unit of risk taken on an apples-to-apples basis significantly outperforms the 60/40 comparative benchmark. Graphically, you can see that the absolute return for the High Rock private client is higher and the risk taken is significantly lower. Again, this is the key to steady, less volatile portfolio swings, which help to elevate returns over longer periods of time. And of course, we remind everyone listening that historical returns are no guarantee of future returns. But at High Rock, as you also know, we work very hard to provide our clients with the best possible risk-adjusted returns. We also believe that it is crucial that we review your wealth forecast on a regular basis so that we can ensure that your long-term goals are in line with your portfolio strategy and our forecasts for your net worth into the future are up to date and heading in the right direction. Well, inflation is one of our key themes for 2017 as we try to assess the implications for central bank monetary policy and interest rates. If economies are growing, so too should inflation be growing. Well, on Monday, I attended the Capital Economics Annual Conference at the Fairmont Royal York in Toronto. Fun for eco-finance geeks like me and interesting on a global scale, especially as they are one of the leading independent economic research companies in the world. The key word here is independent. That means that they are not beholden to any client interests as banks and investment firms might be. So there is no agenda or bias attached to their research. This is good. They don't hold back. Only their reputation is at stake. So what do they think? Well, as I stated in my blog yesterday, they see a pretty big correction coming in the Canadian housing market, which could be anywhere from 20 to 40%. Now, given the current dependence of Canada's economy on this sector, they think that the correction might knock 1 to 2% off Canada's economic performance. They believe that this might bring the Bank of Canada to cut interest rates by 0.25% later in 2017. Now, this is certainly not mainstream thinking, but most institutional forecasts would be reluctant to be so severe, so it is definitely worth noting. As for the U.S., they think that the U.S. Federal Reserve will raise rates 3 times this year as the economy puts up decent growth numbers on the heels of employment and income growth, resulting in a consumer that will not be afraid to spend. Well, we'll see about that. Now, the Eurozone recovery has decent momentum, and the European Central Bank won't tighten prematurely this time. Risk of economic and political fragmentation persists. Italy's populist parties that wish to leave the euro are tied in the polls with those who wish to remain. Brexit could pose a threat to the future of the EU, and Europe's problems have eased, but as Capital Economics says, they have not disappeared. China's rebound is ending sooner than most expected. Coming slowdown should be gradual. Near-term risks from equity markets and currency and Trump have fallen. But growth will continue to slow over the medium term unless China embraces significant reform. Fall to 2% trend growth is plausible and becoming increasingly likely. Well, I found this helpful. Emerging countries coming out of recessions will be Brazil and Russia. India's economy is about to peak, and China and Korea are actually heading into decline. So a little look at where emerging economies sit right at the moment. Well, all central banks have a mandate to maintain price stability, but other than the UK, inflation remains well below target for most advanced economies. Tomorrow we will get the European Central Bank decision, which will likely have no change, but the US Federal Reserve will raise rates by 0.25% on June 14th or so, says the consensus opinion. Well, U.S. core inflation is actually still well below target, but unemployment continues to fall below what the U.S. Federal Reserve might consider full employment. So this is certainly the catalyst. And although U.S. employment growth is slowing and wages are not rising as much as expected, this does not seem to be deterring the Fed from their interest rate path. Well, as Paul mentioned minutes ago in his blog this morning, bond markets are telling us something, that they are not worried about inflation. Now, that could mean that the U.S. economy is actually looking weaker than the U.S. Federal Reserve believes it to be. The Fed has been promoting stronger expected growth for the past 9 years and has fallen quite short of their expectations. Well, as short-term bond yields rise, that's the gold line, with short-term interest rates, and longer-term 10 and 30-year, the green and purple line, bond yields remain the same or fall, the yield curve becomes flatter. Now, historically, the flatter the yield curve, the more likely a recession is to follow. Now, the 2-year to 30-year differential has narrowed considerably since the U.S. election. It narrowed by an additional 8 basis points last week, from 160 basis points to 152. So now the gap between the short yields and long yields is just a little over 1.5% and falling. On the debt front, global debt levels are growing at an approximate 5% per year, while the global economy is only expected to grow at about a rate of 3%. So that tells us something. As we've continued to mention, Canadian household debt is at record levels. Last week, the International Monetary Fund urged Canada to take further action in order to address rising household debt levels and the risks of a sharp correction in the housing market. Well, that coincides with what Capital Economics was telling me on Monday. And as we mentioned last week, almost 3/4 of Canadian homeowners would have difficulty paying their mortgage every month if their payments increased by as little as 10%, based on a survey from Manulife Bank. Interestingly, on Monday, when I was at the Capital Economics conference, they did not really discuss U.S. household debt in any significant way. My take is, as I mentioned in my blog this morning, is that despite the increase in U.S. household debt, the servicing of that debt is still rather low. And while 0.75% increase in interest rates might start to be a factor, Capital Economics believes that the current growth of employment in the United States and the resulting potential for wage increases will assist the consumer along the way in that. We'll keep an eye on that, of course, though. As we've mentioned on previous webinars, emerging market countries have been building debt, and China definitely tops the list. On May the 23rd, Moody's Investor Service cut its rating on China's debt. Well, it's no surprise. We think stocks have been and are still expensive. The 12-month forward-looking price to earnings ratio is already at 17.7 times, which is a high, while the 10-year average is at 14 times, so well above the average. In time, prices do tend to revert back to their mean, which indicates that earnings will either have to grow by a significant 20% more than the currently expected 10% growth to bring the ratio back to its 10-year average. Either that or the S&P 500 will need to correct by about 20%, or perhaps some combination of the two. When we look at another of our metrics of value, enterprise value to EBITDA, it also shows stocks to be as expensive as they were back at the time of the dot-com bubble. So again, obviously we think equity markets, especially in the United States, are expensive. Stock prices have been outperforming economic growth, and high equity prices equate to high risk. So we shall remain patient. And as the Fed reduces the liquidity in the system, which has pushed stocks to these expensive levels, and that's what they are in the process of doing as they raise interest rates, stocks will lose their driving force. The Fed wants to gradually take this bubble away, but it is a delicate maneuver. Well, on the geopolitical front this week, where are we on the Trump agenda? Well, the White House is hoping to kickstart its stalled legislative agenda with congressional action on health care reform this summer. That will clear the way for lawmakers to begin work on a major tax bill after the September 4th Labor Day holiday. That is from an administration official, which we're given that information on Monday. But other issues have been providing some distraction, and certainly this Thursday's testimony will be one of them. All eyes will be glued to what James Comey will have to tell us. And whatever the outcome of Britain's election, some hedge funds are still betting that sterling will fall, anticipating Britain's exit from the European Union will lead to an economic slowdown, whichever way the vote goes. Now, the pound has fallen 2.5% in trade-weighted terms in less than 4 weeks, as opinion polls showed the opposition Labour Party gaining ground on the ruling Conservatives before today, raising the prospect of no party winning an overall parliamentary majority and some form of coalition government emerging. However, even if the Conservatives prove the polls wrong and secure an increased majority of parliamentary seats, many hedge funds expect any recovery in sterling to be short-lived, according to the Reuters story that I read today. And of course, we seem to be reminded daily of the potential for terrorist attacks. So here at High Rock, we want to continue to get portfolio growth, but we are also not comfortable taking equity market risk with overvalued stock prices. The U.S. economic cycle is in its late stages, and there are signs that make us uncomfortable with having too much risk in our models and portfolios. We and our clients have worked too hard for our money, and we want to make sure that we invest it prudently. We are stewards of wealth here at High Rock. We are not gamblers. Paul, anything to throw into the mix today?
Just one really quick thing. We initiated a new position in an oil field services company. So these are not an exploration and producing oil and gas company, but rather, in fact, this company happens to be a drilling company. So some on contract, some not. Anyway, we initiated a new position on this company. It's got a very good balance sheet now. It turned out some debt, so it's got good runway. It doesn't have any immediate debt maturities that could be problematic. It raised capital over the past 6 months. and it's in good shape. So now what we need is, I'm not entirely sure what we need other than the price of oil to go up, but I'm not sure what's going to happen in the Middle East. So oil actually had a good day today. We're up about $1 or so. And just as an aside, some of the positions we've taken in some energy companies, and most specifically producers, we've really managed our risk well. And I think I've said this before, but like last week alone, Scott, we had days where some of the energy equities, the stocks that we owned, Wednesday they're up 6%, or down 6%. Thursday they're up 7%. Friday they're down 4%. These are pretty big swings. Today's, they're up 3-4%. They're pretty big swings. So we have managed our risk pretty well in these, and just trying to add a little bit of value where we can and enable us all to sleep at night. That's it.
That's great, Paul. Great work. Thank you so much. I'm sleeping at night anyway. But as always, we want to take a moment to thank everybody who's taken the time out of their busy schedules to listen in today. As always, if you have any questions or concerns, we want you to feel free to email them to us. We certainly look for feedback, and we want ideas of some of the things that you want us to talk about here. Hopefully we're covering most of it. I will also, all of our clients know this, and I've already set up my meetings with them and some prospects, but I will be in Vancouver on June the 21st and 22nd. And if anybody listening in on this particular webinar would like to arrange a meeting, please don't hesitate to let me know. I would be more than happy to sit down and talk about why High Rock is a significantly better alternative as we move forward in time. In any event, we will be back with our next update next Tuesday. So until then, this is Scott Thompson. On behalf of my colleagues, Paul and Bianca, we want to wish you all a wonderful rest of the week.